right, so we'll just basically begin. And then, since you said one of the challenges is basically having to do with identifying POIs. So one thing I would always say is there is no perfect or 100% zones. That is why most times we talk about waiting to see a lower time frame model before one can take an execution. But then we can have near to a perfect point of interest identification based on having certain checklists we look at, which can be possibly the premium or discount level, which can also be looking at the particular point of interest that took out in liquidity. Because what really happens in the market, what is really just happening in the market is just movement to seek liquidity. Once institutions seek internal range liquidity, you want to aim for an external range liquidity. So basically, liquidity points, liquidity zones are targets that institutions look forward to. So once you identify a block that takes out a liquidity, then that is a block that has the high probability to hold a certain position from. Let's look at is so let me just schematic first. So we have the possibility that we are having a market movement to the downside, and we're having this with AP. Let's just stretch out something. There we look at it. Now, when you're looking at just the normal structure, you're going to carry this as a break of structure, right? Yeah. You're going to consider this as a break of structure. But in reality, the fact is this is not necessarily a valid break of structure. Why? Because yes, this took out this low. But then what you must understand is once a market takes out an external range liquidity, what should validate that low point is like that low point also takes out a liquidity. You get it, sir? Yeah. All right. So this is actually a low. But the fact that this movement went to the upside, there is no liquidity that this took out. So it is not necessarily really a valid low. So and then we have this movement to the downside that took out this low. And now we have a newly created low that went to the upside, taking out this high. So this is not the valid low point, not this low point here. Yes, this is a low point, but it is not valid. This is the most valid because this seeked an internal range liquidity. Are we together? Yes, you are. Yeah. So some may confuse this for a market structure shift. It is not necessarily a market structure shift. So what we are just basically saying is, let's say we have prices come into the downside, a movement, price fell. So we want to see a pullback that would return. Take this, and then this will give us a valid low point. So this is not the valid low point, and then we want to see price continues through the downside. So for us to have a valid low point, we must see price again return to seek an internal range liquidity. Yes, these are low points, but they are not yet valid low points. What will validate those low points is if we can see a return, and now this is not the valid, because this also return and then seek an internal range liquidity. So you can see the high points here took out external range liquidity. The newly created low point here took out an internal range liquidity. So the movement must seek liquidity. So once you understand how price seek liquidity, then that is when you can now understand how to mark your POI. Because now this is what some people would do. The fact that they see that price here give this high points, you would want to consider the other block here as a point of interest. But the truth is, if this price is returning to the upside, you need to ask yourself, where is the liquidity that the institution they want to seek first before they continue to the downside? What you will now look at is that this is a liquidity zone. This is a spot they will want to sweep. Why? Because this is it. Imagine people took an entry there. They took a certain entry there. Price moved to the downside. It means you're going to move your stop loss to this level. Because when you have the pullback and then price continues, when your stop loss will be here. If price again pulls back and then falls, it means your stop loss will be here. People will be trailing their stop loss to the newly created swing low. And then price again pulls back and then falls to the downside. People would move their stop loss here, meaning liquidity is resting here. So the institution to just want to manipulate price, they want to sweep out those liquidities before they continue to the downside. You got it, sir? Yeah, I get it. So once we identify and we establish how we can mark out where the liquidities are, then that is when we can now be able to know how to identify point of interest. So let me go with this stop cap sorting here. So from what we are seeing here is the fact that now we have our price continued down to the downside. Here we have the breakout structure. This is not a valid breakout structure because price has created a valid high path. So we have an impulsive movement. Price gave a pullback, an impulsive movement. Price gave a pullback, and then an impulsive movement to the downside. We have liquidity resting here. We have also liquidity resting here. So these are the internal range liquidities because price has taken out the external range liquidity here. So we have now want to see price seek an internal range liquidity before we continue bearish to the downside. So when you look at this now, what we have is that here is an extreme point of interest. This is an extreme point of interest, and this is a decisional point of interest. Why we call this decisional, it is because it is a 50-50 point of interest. There's a possibility that price will not hold here. So in this kind of market condition, when you have a decisional point of interest, it means you would possibly want to wait for price to create your sell model when price comes to mitigate it, and not necessarily you setting a pending order. But for the extreme point of interest, this is a strong point of interest because why? It seeked this liquidity, and then this is a strong high. So this is what we call a strong high point because it has taken a buy side liquidity, and this is the structural swing high that sponsored the bearish movement to the downside. So these are internal pullbacks. This structures you're seeing here. So it means this is the entire impulsive movement from this high here to this low. That is the entire impulsive movement. So it means these are the internal liquidities. So here you have a decisional point of interest. Price can come here and give you a little sell reaction, or price can come here and then gives you the strong reaction to the downside. That is why I always emphasize we should also be able to trade from zone to zone. Once you identify an unmitigated zone and you want to take your entry from an unmitigated zone, your next target should be that you want to take profits at the next opposing unmitigated zone. So we can have a reaction here because this is a decisional point of interest. Price can sell from here just to return to the breakout block and then goes to the extreme, which is a strong high, and then sell from there. And then again, price can still mitigate the decisional and just continue to the downside. So there are times we don't really have control in the market. That is why we just need to understand how to identify a zone that is fresh and then a zone that is not fresh. So that when we take an entry from a zone that is fresh, we target the next fresh zone, not really targeting an extreme level, because price can react from that opposing fresh zone because there's a possibility that you have an extreme point of interest. So in this condition here, where you are possibly taking an entry from the decisional point of interest, once the market moves in your direction, if you possibly don't want to take your profit because you believe that price will strongly respect the decisional, that is where you trail your stop loss because you're expecting that price will just continue to the downside. And most times, this decisional point of interest have the high probability to continue to the downside if also the decisional point of interest here takes out liquidity. So this is what I basically mean. Let's say the movement here, we have it like this. Let's look at it in this manner. We have it like this. That is this particular movement here. We have price fell, created something like this, and then it fell, and then came like this, and then came like this, and then we have this. So what you can see is that this is your strong high. Now you have liquidity resting here, and then you have the decisional point of interest here. You have the extreme point of interest here. So what you can see is that this decisional point of interest seeked this liquidity. Price swept this high before continuing bearish to the downside. So this is also now a high probability point of interest. You get this point of interest, this decisional point of interest is high probability than this one. Because why? You first had this pullback, price fell, and now this returned and took out this buy side liquidity before falling to the downside. So this decisional point of interest is high probability because why? It took out liquidity. So price can return here and just continue strongly bearish to the downside and not necessarily return to the extreme point of interest. Yeah, so this is also a strong high because it has taken out this liquidity. You get it? Yeah, it is a strong high. This one has the possibility to fail and price will go to the extreme because this one took out this internal range liquidity. We know that yes, this is a strong high. You know also that this also is a point of interest because there is a liquidity below it. So this is also having a probability that price will respect it. But then this is what has the high probability. You get it?
The scenario when that does not take out a high is a 50-50.
Yes, it's a 50-50. Yes, it's a 50-50. So that is why you would have to want to wait for mitigation. Price should mitigate it and then give a lower time frame model. Okay, let's check this Euro USD. I think let's start from the daily time frame. So now, what you can see in this case here now, from this Euro USD, because we've seen this chart, we've been targeting to see how price was going to come and take out all of this buy side liquidity. And clearly we can see how price have traded bullish, taking out all of the buy side liquidity we've been anticipating. So what I pointed the fact is this. So you can see here that here price came to the downside, swept all of this sell side liquidity. This candle here swept the sell side liquidity and then went bullish. Though we can see that this bullishness did not take out this high points. But what you would now observe is the fact that price returned back into this candle, this bearish colored candle that took out the sell side liquidity before going bullish to the upside. And volume here was failing to close below the volume of that bearish colored candle. You can see volume have just been trading above it, meaning price is failing to violate this candle that took out all of this sell side liquidity. So that makes this candle to really be a strong sponsorship block to consider, because you can also see it carried a strong bullish rejection to the upside. So now price came back. Price was failing to trade to the downside. And what I mean by volume is the candle body. Once a candle body is respecting a block, you should know that it has the high possibility to respect it once it is not violating it. So if we had seen that this possibly continued to the downside, let's say this bullish candle was bearish, and then we see that volume just continued downward like this, then it means that this rejection candle is failing to hold price to continue bullish. What we are going to see is the possibility that it will just continue bearish. And if it's going to continue bearish, where is it going to continue bearish to? You have a fair value gap resting here. But the fact that what you're seeing now is price respected that particular block because volume traded to the downside respecting it. Volume failed to trade to the downside when it came to violate this. Volume was closing above. And then you have a bullish impulse. So what you need now to identify is, okay, price have mitigated the rejection block that took out sell side liquidity. Price respected it. So you have to now transfer your view to where is the next block that is going to hold price. Since what you are seeing is that price respects this rejection block, then you have to look at now what price created newly. It now means that price created this block. Because here's the down movement before the bullish movement that violated this bearish order block. This is the last sell candle before the bullish movement that violated this bearish order block. So we have a change in state of delivery. Why? Volume traded above it. You can see volume closed above the volume of this bullish colored candle and the bearish colored candle. So let's use a line graph so that you can see that. So you can see volume went above this high point. And what you can further see is that when this candle fulfilled, it also closed above the high. Volume closed above the high of this candle week. So basically, we are having that possibility that, yes, our buy side liquidity is our target. You get it? So it means if price is returning to the downside, we are not expecting to see price violate this bullish order block. Why? This candle swept liquidity. This went to the upside. Price returned to the candle that took out the liquidity. Indirectly, it is saying this is a strong low because price swept sell side liquidity and went bullish. Price return. You can see how volume here failing to violate the volume of this bearish colored candle, and then we had bullishness. So it means we don't want to see price violate this. Why? We have sell side liquidity taken. So what next we'll be expecting to see is actually the buy side liquidities to be taken. So this year took out this buy side liquidity. We had a breakout out of this consolidation, or let me say range bound movement. We had a breakout out of it. So price returned back into it. It returned back into it in confidence to the fact that this is the sell candle before the bullish movement that gave us this change in state of delivery. and then we have a fair value gap. So that was why I can't remember. I think when I shared something, I said we saw Tuesday. This was Tuesday's candle. Gave us strongly what? Bearish movement. That was why I said we need to expect to see price with dip more lower, because also we have a fair value gap. And I told us we want to see how price will respect the volume, and then would have our bullish continuation. Why was I so confident about this zone? It is the fact that we can see liquidity sweep, bullish reason, price return, failed to take out this candle, volume failed to continue bearish, to violate this candle that swept the sell side liquidity. We had bullish reason. That was the strong reason that I expected that yes, a buy would take out, would occur from this bullish order block. So now what we can now see is the fact that that happened, price came and then bullish reason. So this was, let's look at this. This candle here was Friday, and then preparing for the new week, I told us I was more bullish than bearish. Why was I more bullish than bearish? Look at this fact. Price returned to this bearish order block. Bullish rejection. Bullish rejection. And you can see that the volume here went bullish, strongly bullish also, closing above this bearish candle high points. Closing above this bearish candle high point. It means price is respecting this zone. What you can see is price swept to the low of this. So if you're going to see bearishness, at least the volume of this candle should have closed below these low points. But after mitigating this, price gave strong bullish movement to the upside, closing above the high of the bearish colored candle. So hence why the weekly forecast I told us we could just see now, anticipating to see price aim for our buy side, because price is already close to the buy side liquidity. Yes, sell side liquidity has been taken. And what you can also see is when price created this pullback, here also a sell side was taken out. A sell side, as the previous low of this candle, was taken out. So inside it was the last sell movement before the bullish movement. Price went to the upside. So yours, and we can see now Friday returned to the downside here. So this is Friday's candle, last week Friday. So when Friday returned, what you can see is that Friday mitigated the volume of this candle, of the bearish candle, the sell movement before the buy movement. And what can you see? Bullish rejection. Price reacted from a bullish order block, bullish rejection, to the newly created engulfing candle. Price return, retested it, bullish rejection. So it means we're looking forward to the buy side and then buy side. So why I say we trade zone to zone. So even if you're looking forward to buy to the upside, you now have to identify the first level where you need to take your first take profit. It is this rejection block. Yes, you know you have the buy side here, but then you have to trade with being conservative. The next target is the buy side resting here. Sorry, the rejection block resting here before looking forward to the buy side here. Because there's a possibility that when price comes into the rejection, we're going to have bearish reaction. And since we didn't design the market, we don't know if the bearish reaction will be so deep and then need to take out our stop loss. So that is why at times you just target from where you're taking your entry to the next zone. And that is basically looking at the lower time frames. So this is now just explaining this narrative from the daily. So when you go to the 4-hour, you can go to the 1 hour, but I like to check those charts from the daily. Look also to the 4-hour. Let me do it with some of these lines since they're appearing in that 4-hour. So to the 4-hour time frame. So here in the 4-hour time frame. Now what you can see is this is the daily level. That daily block that price reacted from, which is this daily zone here, this level here, this one. Let me put an annotation so that we can see that when we drop lower. Let's go to the 4-hour. So you can see that is that place. So you can see from the 4-hour, you can see the rejection. You can see it. Now, what can you also notice from the 4-hour is this. You have the structure went to the upside. Let's look at it. So basically we had this movement, price pullback here. We had this movement, we have a pullback here. Price went to the upside. Price came down. We have a pullback here, price fell. And then we had this. So let's look at this. So first, what you're also going to see from the 4-hour is this. Price here give us a reason to anticipate price to respect this. Because this took out what? A sell side liquidity. I seen it, sir. So price went bullish. Price pullback. You can see how price respected that candle. That rejection. price respected it, you can see volume was failing to violate it. When price came to it, basically when you're marking the rejection block level, it is the so now this says this is bullish. You have to look at the down close candle that was created, which is this down close candle. That is the close price. So you place your horizontal line or whatever tool you want to use to identify that. That is the level, because you can see this is a strong week to the downside, meaning we had the presence of sellers that pushed this price to the downside before the buy energy came in. And where is the candle in which actually the sellers began the sell movements? It is from this candle. This was the last sell candle. From this sell candle, sellers sponsored more bearishness, because you can see this is where the open price of the bullish candle was. This is the close price of the bearish candle. You have the close price here of the bearish candle, the open price of the bullish candle. So when the bearish candle closed, that is a sell candle, the sellers continued to send price lower, but then the buyers pushed it. And then we have price close above the open price. So what you can now see is you had the movement, price again, you had a sell side liquidity here. After this candle took out this swing low sell side, we had a pullback, taking out a sell side resting here. We can see how price failed to violate this rejection candle. Volume came, failing to trade below this, and then we had rejection to the upside in the 4-hour time frame. So this is the level from the daily, where the daily order block was created. Now you can see how price came to the daily zone here. And if you're looking at this structurally, this is what you can see. Internally here, after price mitigated, let's go back to the daily time frame. Sorry.